This
Uh,
conference will now be recorded.
in the interest of time, I'm going to go ahead and get started, just so that we can jump in. And like a lot of the, we've got some. Sorry, give me just 1 second. Let me make sure that Circe is able to hear me. All right, I apologize. Hello, everyone, and thank you very much for your patience. We're going to jump in to advanced business and financial management, and this is a pretty good topic, and one that covers a lot of fundamental concepts that I think a lot of business owners, you have some idea about, but you've never actually put it together. So the purpose of this course is to introduce business owners to the fundamental principles of management and financial management. The course is expected to benefit you by equipping you with certain knowledge and skills and tools in order to successfully manage your business and avoid common pitfalls, specifically as it comes to cash flow and cash management, which is always one of the biggest, one of the most important things for any business. So jumping in, again, a little bit about my background, and I think I'm not able to see everyone, but I think that most of the folks on the line have some idea who I am. But for those of you who may be joining for the first time, my name is Bernie Deer. I've been a project manager since 2001, and that's kind of where I ended up getting connected with HACIA. On the business front, and as it pertains to some of these trainings that we're doing together, I do have an MBA, and I graduated with a minor in project management. I've been out of school for about 12 years. I'm also certified as a PMP, a certified Scrum Master, and then also a Six Sigma Black Belt. And I hold professional certifications in project management, financial management, team development, and executive leadership. Presently, I am the president of Midwest Business Consulting, a small consulting and coaching group based out of the south side of Chicago. And I've been employed at that since 2012. So just kind of a bit of background on who I am. We're going to start out this evening. This is going to be a two-session class, and we're going to start out this evening and really hopefully create a good understanding of cash flow and how you should be managing cash flow just from a very general business standpoint. So our topic, learning objectives for this evening, we want to understand the purpose and function of a very basic chart of accounts. Everyone hopefully should be using one of these for their business. We want to talk about the difference between cash accounting and accrual accounting. And I think that a lot of people, again, have some general understanding, but there's some nuances to this. And later this evening, we're going to talk about reconciling these two so that we can make good informed business decisions. We want to understand the purpose and function of a budget, and we want to understand, and we're not going to go too much into developing a budget. We could dedicate an entire evening or two to just that, but I'll give you some pointers on how I typically go about developing budgets for clients. We are going to touch very quickly this evening on the basic financial statements. And specifically, we're really going to focus on the income statement and the balance sheet, but we'll also touch very briefly on the cash flow statement and at least create an understanding of what that document is and why we might need it. We're going to talk about classifying business expenses, and this is a category that's really going to feed into our discussion on Wednesday. So I'll kind of pound down the table and ask you to pay attention when we get there. We're also going to talk about managing cash flow and managing our tax liability. And then we will also talk about the importance of cash to accrual reconciliation. And I think we're going to touch on some methods to finance the business. So if there are no questions to get started, I'm just going to go ahead and jump in, seeing as how we're a few moments behind tonight. So the first thing that I want to talk about is a chart of accounts. I'm not certain if everyone is using one of these, but if you're using some type of an accounting software, you are using a chart of accounts. And I like to describe it as it's a bucket. It's some place that when we spend a dollar, we have a system that we can categorize what that was for. Some of our dollars are going to be spent on payroll. Some of our dollars are going to be spent on marketing. Some are going to be spent on rent. Some are going to be spent on entertainment and meals and office supplies and all of these other things that go into running a business. It's very, very important to understand how your business is consuming funds. Without having some type of a chart of accounts, you would have a single number. I would say, well, what do you think you're going to spend? You'd say 650,000, and I go, well, where did you come up with that number? How do you get that? You go, I don't know. It's what we spent last year. You would have no way to really think about it. By having a chart of accounts, we can zoom in to one specific expense account, and I can say, well, what do we think we're going to spend on office supplies? That is a much better thing that we can focus on, and I can say, well, we'll spend about $100 a month. Great. My budget this year is $1,200 for office supplies. Next, what do we think we're going to spend on marketing? And we can keep doing this for all of the expense categories that are in the business. So taking a look at the screen here, it says that a chart of accounts is a structured list of accounts that are used by an organization for the purpose of classifying revenues, expenses, COGS, and assets. For those of you who may not know, COGS is an abbreviation or an acronym rather, and it stands for the cost of goods sold. While it may seem like an expense, it's kind of a special category of expenses. For instance, if we were selling pens, if this is what I was selling, and I was selling them for $1.50, but I had to buy each pen for $1, every pen that I sold would accumulate $1 in COGS, or the cost of goods sold. So COGS typically goes into whatever is directly relatable to whatever the business is selling. When you are creating your chart of accounts, a few tips, and typically if you're using this, you probably already have some ideas. What I would try to do is spend some time and think about what is the most ideal chart of accounts. And the reason that I say that is we're going to talk about a horizontal analysis here in a few slides. If your chart of accounts changes every single year, it is a nightmare to try to make any year-to-year comparisons. I'm like, wait a minute, what's this account? And that wasn't here, and this account changed, and that one rolled into there, and this one changed the name. Spend some time. I would consider this to be a foundational component of the business. And if you have a bad foundation, the business is going to keep on falling. So spend some time here. Here's another thing that I would offer. You do not want your chart of accounts to be so granular that you have some accounts that have $1.50 for the year, right? And some accounts that have 26. All of those oddball accounts, that does nothing but distract you from the things that you need to be looking at. All of that can be collapsed into miscellaneous office supplies or miscellaneous marketing expenses or whatever you think is a good category, right? But you want to make sure that the accounts are useful. So you don't want to get so far down into the weeds that the chart of accounts loses all meaning. Somewhere between 25 and 50 might be a decent number of accounts, okay? So does anyone have any questions about chart of accounts before I move on? Good. Leticia? Yep. You can
My
unmute. Yep.
question, my question is, the chart of accounts is similar to what you see in QuickBooks?
That is what it is. It's not similar. That is it. So your chart of accounts is something that will be used by your accountant or your accounting program or system in order to classify revenues and expenses for the most part, right?
So
So
then generally does QuickBook have like a set of accounts, but then you can add more accounts?
got it, yeah. So it's such a pain in the butt, and most people have no idea. So with almost every accounting software and every software I've ever seen, you can always start with a template. So they'll say, well, what are you? You're a service business. You go, yeah. And you go, well, are you professional or are you construction or are you, if you're doing lawn care or whatever it is, you can select it and it will give you a suggested chart of accounts.
Now, is QuickBooks smart enough to know, like, when you use your business credit card and you charge for supplies and equipment and all sorts of different things, is it smart enough to know about your purchase and where to place it in the correct account?
Probably not. Yeah, so I mean, it's not going to be able to classify it. You know what I mean? If you went and it depends on what your business is and what it does. QuickBooks may be smart enough to where you can pre-program it for some purchases. But I actually use Sage products for the most part. We use QuickBooks. We do, but very, very little. I'm more of a Sage guy, but Sage doesn't do that either. I don't think there's any software that could, unless you programmed it. If you said, listen, every time that I go to Home Depot and buy sod, this is how I want that to be booked. It could probably do that for you because they will sync up. You can sync it with your credit card.
Okay. Thank you.
Yep. So, there's just a note here at the bottom. It says that an efficient and effective chart of accounts is key. Is key to sound financial management and reporting of the business. And so by having this, it'll give you the ability to actually make good informed business decisions. And this is what one might look like, Leticia.
I just want to tell you that I know that Circe was very busy trying to get us online, but she might have not heard you, but I see the symbol for recording.
Yeah, I'm recording it, yeah.
Oh, okay, just as long as you know, because I know you did.
Yep, thank you. So this is what a chart of accounts might look like. This is just a made up. We just went to the internet and said, show me what a chart of accounts looks like and took a snapshot. Your chart of accounts is going to be very, very personalized or customized to your business and whatever your business uses and what you want to call things. You may not have store equipment or land, right? And if that's the instance, there's no sense in having an account for it. In the event that you have billed something to an account, typically you cannot delete the account, but you can mark it inactive in your system so that nobody can select that account again. So spend some time, and again, if you want to meet with your accounting professionals, or again, just print out your income statement from last year and see if you have accounts that have absolutely they all have zero balances, or again, $1.50 or $26. Those accounts are probably not very useful to you. When we come to accounting methods, there are two key methods that we can have. We can basically have either an accrual basis of accounting or a cash basis of accounting. And here is the difference. When do you classify, or when does the business recognize an expense or a revenue? Before anyone asks which is better, I can't tell you which is better. I personally prefer accrual, but I know a lot of people prefer cash. It's really what's up to your business. Accrual accounting recognizes a revenue the day that the work is complete, not necessarily when it's sold, but whenever I am now able to send a bill to the customer. That is called the accrual method of accounting. We will account for that revenue the day that I send the bill. The same thing with expenses. If I ordered something, if I ordered a new phone, whether I have the phone or not, or whether I've paid for the phone or not, none of that matters. I have now incurred a liability. I owe someone that money, assuming that I get the phone. But even say that I had the phone in my hand, I would classify that as an expense under the accrual method. We would call it an accrued expense. It means something that I owe someone money, but I haven't actually paid them yet. Under the cash method of accounting, I only account for something. My business only recognizes it the day that cash comes into the business or the day that cash goes out of it. Other than that, we don't recognize anything. If I was to do a job for HACIA and it was $50,000 and I finished it on December 31st, the accrual method would recognize that revenue as a 2019 revenue. The cash method would not. In the cash method, I would not recognize that I made any money whatsoever until the day I had cash in my hand. Okay, and so the accounting methods are both focused on when does the business recognize or account for both expenses and revenues. Sometimes you might say, well, it's better this way because I want to put taxes off as long as possible, or what if people stiff me and I don't get my money and now I got to go write it off and all, whatever. Again, I don't say that one is any better than the other, but they are both very different methods. You are allowed to switch the method you are on, but you cannot flip-flop, I think, is a general rule of thumb. They say if you're switching more than more than every 5 years, they're going to come and take a really close look at you, and they're going to ask, why are you switching your accounting method, right? Typically, people are doing it to play with the numbers a little bit or cook the book. So it's not that you can't switch, but I would do it very, very sparingly. This is going to become important. Let's see a question.
Yes, I thought I heard that you have to make this choice early on when you're setting up your company.
So I think ideally, if you selected a method, but no, you can change it. What I will tell you is there's probably a little bit of, I've never actually changed one, so I don't know what goes into it. I'm sure if we sat here and brainstormed for a little bit, we could think about it. I would speculate that it is no treat to do.
And where do you go to change it?
It is in your accounting software, HACIA. It's probably under like system maintenance or something like that.
Okay.
Here's what I would tell you though: if you are considering it, again, I would consult with an accounting professional or somebody who specializes in QuickBooks before I did that. Okay.
Very good.
Yep. Okay.
Because we're having trouble with people paying, so and I don't want it to show like
going to the cash.
Right.
Yeah,
okay, well,
yeah.
thank you.
Yep. So it is very important that you understand the difference between these two and understand which of the two you are actually on. And again, there will be some important factors here, specifically when you are on accrual counting. And so this is going to sound a little more complex. You almost have to maintain in your mind two sets of books. And so specifically, I want to know how much money I'm making, like how much business is my company doing? But then I also always need to be thinking about when am I going to get that money, right? And so to an extent, there's the need to have two systems in your head. But both are very, very common. And again, I would probably say that a majority of larger companies are on accrual. I think a lot of times people prefer cash because it makes sense. It's easy. When I got the money, that's when I made it, right? I also want to talk about having a budget in the business. And I typically refer to this to a budget as the helm of the business, right? And so I would say that, second, I see I have a typo. Now I'm recorded with that. I would say that as a general rule of thumb, if you don't have a budget, it's going to be very, very hard for you once again to make good informed business decisions. Why do I have a second error here? All right, well, we'll have to fix these offline, but it says that a budget is an approximation of the quantities of money that the business will either spend or earn in a given time frame. So in a month or a quarter or even a year. A lot of businesses I do find do not have a budget. And I always ask, how do you sleep at night? Like you have no idea. Like you have to make a decision and you just buy a piece of equipment or do something or get a new website and I'm like, but how are you making that decision? How is the business doing? I mean, sometimes if you have plenty of cash in the business and you go, yeah, Bernie, I got it. I'm not worried about it. I'm happy for you. I think that that's an excellent position to be in. But without having a budget, I find that I personally, it's just very, very difficult for me to wrap my brain around the business. So I want to talk about this a little bit. I would tell you that a budget is time phased. So again, remember I said it that it is a documented approximation of the quantities of money that will flow into or out of the business or that will be earned or spent by the business, independent of monies, depending on if we're accrual or cash accounting. But it's time phased, and it's important that it's time phased. Again, for me to just say that, even if, so earlier on I said it wouldn't make sense to say, well, my expense budget is 650,000 this year, right? I'm like, well, no, where are you spending that money? Well, by that same token, I'd also like to know, when are you spending that money? If I know what you expect to spend in January, February, March, and now that it's the middle of April, I can look and kind of get an idea today and see, how are you doing? I can say, you're spending way too much. This is what your budget was. You need to control that, right? Or we can look at our revenues and we can project this forward to determine, again, are we able to afford something or aren't we? So the budget is going to be time phased. That's important to understand. It says here that it's used to aid business leaders with projecting the profitability of the business, evaluating performance, and making informed business decisions. Here's the important thing about that. I can do that at any time. A lot of times I'll say, well, are you going to make money this year? And you kind of laugh and you go, I don't know. We'll see in the end of November if I think I'm going to make money or not, right? My accountant's going to tell me then. And again, that's a very challenging way to run a business. I would rather know and say, again, with the information that we have available to us, I know what we've done so far to date. I also can kind of look and see what the variance has been. If every month, if my revenues have been about 10% under month after month after month, and I don't see anything changing for the rest of the year, I'm going to go and change my projections for the rest of the year, and I'm going to lower it, my revenue projection, to 10% lower, because that's been the trend. Listen, let's hope that the company does great, but I would rather plan for the worst right now, right? And we really need to be very cautious when we're doing this. I can also update my projections. I'm going to tell you the budget won't change, but our projections can change throughout the year. And so by having this tool at any given point in time in the year that you ask me and say, Bernie, how do you think the business is going to do? I can pull out my budget and look at what we've done so far to date and look at how I thought we were going to do for the rest of the year. And I can say, I think that we're actually going to finish here for the year. Well, this says it's referred to. No one else calls it the helm of the business. I'm an old sailor, and so I call it the helm of the business. This is how you actually steer the business. This is how you are going to navigate what the business does. The way that I typically describe this is, throughout the entire year, you should have your hand on the helm, just like a steering wheel on a car. And you should be making slight adjustments back and forth to the helm. And based on however the business is performing, we go this way or we go that way. The idea behind this is, if you wait until the end of the year, just like if you were sailing a ship or driving a car or flying a plane, the longer that you are going off course in the wrong direction, now you have to make a very sharp change to get back on course to where you wanted to get to. Where as long as you're managing it all year long, you're just making these very small adjustments to your course and you're staying very closely on budget. So again, the budget is very important to steering the business, making informed business decisions. As a general rule of thumb, most budgets are going to follow a kind of an income statement, right? You're going to have my income and then my cost of goods and my expenses and then profitability listed at the bottom. Sometimes you may have people in your organization, this group is only responsible for generating a sales budget, right? Or our revenue budget. And we have other groups that are responsible for producing expense budgets. But someone at some point, somewhere in the organization has to marry those two documents up and say, right now, are we predicting that we will make money this year, right? And so it's very important to have that understanding of what we think the business is going to do. So budget, very, very important. This is what a budget may look like. This is actually an annual budget. I see here that, let me turn my pointer on. I have my income accounts up here, and I have services and reimbursed expenses and agency fees, and I have my cost of goods sold here, and then down here I have my expenses, and ultimately down here I would have a line for profitability, and I have each month, January, February, March, April, May, on and on. And so this is how we could lay it out. This would be a really good way for us to think about our budget. If you look here on the left-hand side, the expense accounts that I'm using, they're from my chart of accounts. These are the exact same accounts that are coming from my accounting system. It makes it very easy for us to create a budget. Typically, we want to use historical data to at least set the stage for this. And then we can say, well, that's what we spent last year. What do we think is going to happen this year or into the future? And we can use that to kind of develop this to the best we can. One thing that I am going to tell you is the budget, ideally, when you set the budget will not change. Anyone who's going to take my Project Basics course coming up next month, next week, I'm going to tell you that the budget will not change. Once you've set the budget in November or December for the coming year, you should not continue to change your budget. And here's the reason why. If you do that, so Carolyn sets a budget and says, Bernie, I think that I'm going to make $400,000 this year. And then in March, she says, I don't think I'm going to make 400,000. I think I'm going to make 380,000. And so she changes her budget. And then in June, she goes, I think we're going to make 320, and she changes her budget to match that. And then in December or in November, she says, I think we're only going to make like 305. And at the end of the year, I say, well, Carolyn, how'd you do? You go, perfect. We came in right on budget. You didn't come in on budget. You kept changing your budget to match what you were doing. What the budget does, I call it a snapshot in time. What I want you to think is when you set that budget, I'd like you to take a picture of it. The picture doesn't change. The reason that it doesn't change is it allows you to compare how good of a job did you do budgeting, so that next year you could say, well, we budgeted this for office supplies. We were way off from our budget, right? And we can also go back and ask questions like, why were we so far off from the budget? I'm not telling you to not change your projections. I'm going to go on to the next screen here. This is ordinarily what I would recommend, how I recommend you keep it each month. So now I've zoomed in a little bit. I've expanded those columns. The month of January now takes up 4 columns, as you can see here. Everything on the left is exactly the same. The first column is the budget. That is the column that I am telling you never changes. The budget is the budget. The second column, though, is a projections column, and that's the column that we will use to make our business decisions. So as we go and look at the month of February, I can see that in January or sometime in February, I projected that we were actually going to do more revenue than we thought. Not much, but $3 grand. However, my professional fees were going to be significantly more than we projected, right? And so we can keep the budget and still use projections for the business. Again, the idea behind not modifying the budget is it allows you to go back at a future date and compare how good of a job did you do budgeting? Okay. And so we have each year, and then we have a quarterly report over here on the side. It is often very helpful to look at each one of these months as well as each quarter, because sometimes it's a timing issue, right? And so as a general rule of thumb, I can look and see, well, how did I do for the quarter compared to how I thought I was going to do? I did terrible in January, but I crushed it in February. Well, when I look at the quarter, at the end of the day, it all came out in the wash. There was just a timing issue of when a job went. I thought it was going to finish in January, and it didn't. It finished in February, right? So this is, I think, a very good approach to that. We see that the next column over is an actuals column, and this is what we actually did. And we see that it triggers this variance column, and so I can look for any variances. Typically, at the end of each month, we will go back and look for any major variances. You should be looking at this and saying, wow, why are we doing better or worse than we thought we were going to do? And you should put some notes in here. You will not remember in 2 years, okay? And so as you are trying to set your budget and you're using historical data, if you didn't say the reason why you had a really terrific February, it's going to be hard to remember that next year. So take good notes, review this each month and each quarter, okay? So this is what a budget would look like. And then this is just zooming into a single month, just so that you can see a little more clearly what this budget looks like. So again, each month I'm actually showing that there's a budget, we have projections, we have actuals, and we have a variance column. QuickBooks and a lot of the accounting softwares will do something similar. I use Excel, I'm an Excel geek, but so there is something similar that you'll find in most of your accounting programs, but just so you understand that we are keeping these documents or these columns or figures separate. Any questions on the budget? Okay. I'm going to jump into the financial statements, and specifically, we're going to focus really on the most important two. The first one is the income statement. This is really one of the most important documents that your business will generate. It is very often called a profit and loss statement or a P&L statement. And it says it is a key financial statement that is used by the business as well as third parties who want to evaluate the business. Think about bankers, right? Or investors or anyone who is thinking about working with your company. And this really allows somebody to determine whether or not the business is profitable and to what degree it's profitable. And we can look at it a few ways. We can look at it just a number, and we can also look at that number as a percentage. If I said, you made $1 million last year, is that good or bad? I don't know. It's hard to say. How much, if you did $8 billion and all you made was $1 million, it's probably not so good, right? Your profit is so minuscule compared to all of the business that you did. So you really need to look at it in relation to the rest of the business. Income statements generally follow a very standard format. There is an organization that theoretically oversees all of this, but small businesses, while you are not allowed to cook the books, right? So you can't cheat Uncle Sam, and you cannot mislead or defraud investors or anyone like that. Generally speaking, there are no strict rules on how you would do this. But as a general rule of thumb, this is the approved format that you see up here. Revenues minus the cost of goods sold gives you the gross profit, also called your gross margin. from that number, we will take out our expenses, and that's going to yield our net profit or our net margin. Just for the sake of everyone on the call, when we say revenues, the word revenue is synonymous with income. It means the same thing. It is money that we have earned. So anywhere that you see revenue or income, I'm talking about money that the business has earned. Once again, the cost of goods sold looks like an expense and feels like an expense, but it is really the cost of materials or labor that has gone into producing whatever it is that your business sells. It is a very specific type of expense. And expenses are obviously costs, money that we spend to manage the business. So this is a typical format that you will see in anyone. If you're using an accounting software, when you go to reports and you print your income statement, this is exactly what you will see. Although under the expense and the revenues, typically you'll see all of the accounts listed. This is a rolled up format. There are some, so items such as interest and taxes and depreciation and amortization, a lot of these would actually end up coming out after the fact. So that net margin that I showed you is a general rule of thumb for many businesses. That's kind of it. However, for larger corporations, there's a lot of other things that will go into it. So they may put depreciation on equipment that they purchase or taxes, things like that, they would put below the line. And so most of the time, the number that I was showing you, and I'm only telling you this in case you hear the term, it is referred to as EBITDA. And so as you look right down here, this is EBITDA. This stands for, and this is a real term, this is not a Bernieism, this stands for earnings before interest, taxes, depreciation, and amortization. And so usually, again, smaller companies, we're not worried about EBITDA. If somebody asked you, what is your EBITDA? You're going to tell them what your net profit is, right? What's your net margin? That's the number that they're asking for. So this is what an income statement might look like. We see that we have our revenues at the top, just like I said. This here actually should have COGS, but it doesn't. I was going to say it's a service business. Typically, if you do not see COGS, you may be a service business. There are service businesses that will have a COGS listed, the cost of goods sold, but a lot of service businesses won't. Here we can see that we have revenues, 24,800 and 3,000. So we have two different revenue accounts here. We have sales and lessons. We have our total revenues. We also then right below that, we have our expenses. Our expenses total to 14,000. Once we subtract our expenses from our revenues, we can see that we have a net income of almost $13,000. So we've got a positive cash flow at the end of the year, or at least positive profit at the end of the year. So all income statements are fairly similar to one another. I'm going to go through another statement and then we'll take a break here in just a moment, okay? The next key financial statement that you should be familiar with is called a balance sheet. This is sometimes, called by bankers though, sometimes called a statement of financial position. And it says that it is a key financial statement that's used by the business as well as any third-party evaluators to determine the company's financial structure. This shows all of the assets of the company. What assets does the company have at its disposal? And then I like to think of it as those assets that you have, who owns them, right? And so because you have the asset does not mean you own that you own it. If you have a home, if you have a mortgage on your home, you do not own the whole thing. If your home is worth $100,000 and you have you still owe $60,000 on it, you have a $40,000 equity position and the bank has a $60,000 position in that, right? And so you might look and Carolyn would say, well, I have a $100,000 asset. but out of that $100,000 that I have available to my business, I only own 40,000 of it. The bank or some other individual owns the other 60,000. And so the balance sheet shows for the assets that the business has who actually owns those. So it says here on the screen that the balance sheet shows all assets of the company along with all associated liabilities. So you understand the term liability means that you owe someone money. So if I have it could actually have a lot of different meanings in business, right, or in the legal world, but as we're talking about it, if something is a liability, that means that I owe money on that. So if I've purchased a new cell phone, I don't know, what are they, $1,200 now? When they send the phone to me, I now have an asset that is worth $1,200 at my disposal. However, I have a $1,200 liability now that matches this until I pay that off. After 1 month, I now own $100 of this, and the phone store owns the other $1,100, right? And it keeps going down by $100 a month until it's completely paid off. So all balance sheets will be laid out the same, and it generally follows what is known as the accounting equation. The accounting equation is this. It says that assets are equal to liabilities plus owner's equity. That is it. That basically sums up everything that is in the business. What assets do you have? And on the other side, who owns those assets? And no matter what, those two numbers always have to be equal. If I have $1 million, I can't say, well, of the $1 million that's here, I own 200,000 and I owe 100,000. Well, where does the other 700,000? Like, that money belongs somewhere, right? So either you don't have $1 million or you own much more than you think you own. So assets will always be equal to the liabilities plus the owner's equity. And so this is the accounting equation that we see here on the board. And this basically sums up the balance sheet. And this is what one might look like. We see that we have all of the assets of the organization. And when we come down to the bottom, I have $910,000 in assets. And I have some in cash and some in short-term investments, some in receivables, inventory, on and on. I can see that I also have some liabilities here. My total liabilities is $450,000. And then my equity is $460,000. And when I add my liabilities plus my equity, I see that my those two numbers added together will always match my assets. Okay, does that make sense to everyone? And does everyone understand? So an asset, to finish clarifying the term, so I told you what a liability is. A liability is anything that the business owns. An asset is anything of value that the organization has, again, at its disposal. Money, property, equipment, inventory, finished goods, work in progress, computer equipment, copier equipment, furniture, vehicles. These are all assets. It is something of value that the business owns. The word equity refers to your ownership stake in that. Okay, so if you had a home for a while and you were paying on it, we would say that you have equity in your home, right? Or do you have any equity? Or maybe you've taken out a home equity line of credit, right? You are basically pulling equity out of your house. That means that the money that you've accumulated, that you've paid off, you're pulling the equity out of it. The bank is giving you, they're buying your equity back from you, okay? So equity is the portion that you own. The last statement that I'm going to talk about, and we'll take a break after this because there's only 3 of them, is a cash flow statement. And a cash flow statement basically just tells the business owner how the cash position has changed over the course of a month or a quarter or a year. Here's the reason why. We already have the income statement. And the income statement theoretically tells you whether or not you're making money. But it doesn't have anything necessarily to do with cash. I already told you that if you're on accrual accounting, you might log a $70,000 revenue, but you didn't get any cash for it, right? So now your income statement's going to go, you're doing great, you made $70,000. You're going to go, my cash went down. I didn't get any money for that yet. When you buy something, if you were to buy a $100,000 backhoe or bulldozer or semi truck, that is not an expense. You took an asset, which was $100,000 cash that you had, and you converted that to a vehicle. You still have a $100,000 asset. There is no expense. I'm going to go back to this statement for a moment. Here is cash. We took this $100,000 and we would have put it into, well, they don't have equipment here, but we would have dumped it into equipment that it would still show up as an asset, and we would depreciate it over time. Your income statement would not show that anything happened whatsoever. It would go, yeah, no, you didn't buy it. You know, you didn't actually spend anything. You changed the form of an asset from a stack of cash into a $100,000 vehicle. And if we said, well, that vehicle was going to have a 4-year lifespan, we're going to talk about depreciation. At the end of the year, we would say, well, now I have a depreciation expense of $25,000. Okay, and so the cash flow statement it helps you to understand how your cash position is changing over a period of time, whatever that time is. So certain accounts receivable in May, when Leticia does pay me the $70,000. Again, my income statement is not going to show any income whatsoever. The income was already booked in April, right? But when I get that cash, so nothing will show up on my income statement for May, but my cash flow statement will show me that money was actually received into the business. If you are on cash accounting, if you're using the cash accounting statement, this typically means much less to you because it really all has to do with cash. But there is still some function when it comes to things like depreciation, which we will talk about this evening. And this is what one might look like. Basically, it looks at where the money started and where the money ended for that period, and then it talks about every place that money came in and every place that money went out. And typically it tries to reconcile it to the income statement. Not tries to, it does. This is not used as extensively. Most banks, if you were to go for a loan, or anybody who's going to do business with you or thinks about getting involved in your company, is going to ask for a balance sheet and an income statement. Cash flow statement, not as much. Any questions on budgeting, on a cash versus accrual chart of accounts, or any of the financial statements? No? Okay. Why don't we do this? It is 6:30. Why don't we take, well, it's 6:29. Why don't we take about 7 minutes? We'll come back at 6:35. Actually, 6:28. So, okay, thank you. Hey, Richard, how are you? What was your question?
I'm good. How are you?
I'm really well. How was your holiday?
Good. It was great. I kind of chilled and watched TV.
Yeah, all right.
Yeah.
That sounds like a good time. I can dig that.
Well, you know, I could sit and I could do my little design, so I was doing that.
All right.
So that worked good though. And yours?
Good. Yeah. It was good and relaxing. We did a FaceTime. So very much like this is how we did Easter dinner this year. So
good.
A little chaotic, but everyone's healthy. That's the best you can ask for, right?
That's the most important thing, though.
Yep.
Really.
Yeah. Seriously, hopefully you're able to hear okay. Everything's good? Yep. I see that you unmuted it, Seriously, but I didn't hear anything. All right, I think we jump back in. How's the pace? Is the pace okay? Good.
Yes,
Yes,
it's good.
it's very good
Okay. Okay.
because some of it is new material, so it's good.
Yeah. Yeah. And some of it you might have heard in the past, but just never really kind of formally
Right.
learned. So, um, okay. So on touching back with the financial statements, it's important again that the business owners or the business leaders, whoever is kind of again steering the ship, I'll say, reviews the financial statements and is familiar with what is being indicated by how the business is performing. There are a few different ways that we can think about this. One way that we can look at how the business is performing is called a horizontal analysis. A horizontal analysis, if you think about horizontals like the horizon, right? So it's going from one side to the other. A horizontal analysis compares one period to another period. So we might compare 2019 to 2020, and I can look and see how did I do in February, how did I do in March, and on and on. So horizontal analysis compares the performance of the business for expenses or for revenues from one period to another, and that can be very, very informative. A second type of analysis, though, that we can perform is called vertical analysis. Vertical obviously goes up and down. The vertical analysis looks to see how certain accounts are performing as it relates to the whole. For example, I might look and say, well, what percentage of your business are you spending, or of your revenues are you spending on marketing, or what percentage are you spending on personnel or insurance or any of these other things? A vertical analysis would look at the number next to marketing, and it would compare it either to all expenses or to the total revenues for the year or the net profit, whatever you decided. And we can look, and I can look year to year and say, Leticia, listen, you're asking me why the business isn't doing so well anymore. And I'm going to say in 2016, you were spending 38% of your money on personnel. The next year, you were spending 42%. Now you're spending 53% is going toward personnel expenses. That's an important number, right? And so we're watching that. And so vertical analysis looks at how the numbers are performing in relation to the total revenues. Here's the reason why that's important. Some years we're going to do great. And what I would hope is that when we're killing it and our revenues are sky high, that's when I would expect to see my expenses up. When I'm not making so much money, hopefully my expenses go down with it. Okay, and we're going to talk about fixed expenses this evening as well. And so we can talk about some strategies there. We will touch on variance analysis, or I should say we've already touched very briefly on variance analysis. We're going to get more into this next week as it pertains to specific jobs. But here, what variance analysis refers to is how did the business actually perform, either by account or by revenue or for the month or for the year or quarter. How did it actually perform compared to how we thought it was going to perform? Our goal should be to explain any variances that we see, positive or negative. We should always be inquisitive. Why did we spend much more than we thought we were going to spend? Or we did great this month. Why did we do great this month? And so we would call that a variance analysis. It refers to how did we perform against how we thought we would perform. And then the last one that we'll touch on here is going to be trend analysis. And trend analysis just looks to see how a situation is changing over time. So as we were talking about Leticia, I could look at year one and see it's here, year two, see it's here, year three, and see it's here, year four. And I might eventually suspect that the next year is going to be here because I can analyze what that trend has been, right? And so we can use that trend analysis to make some to speculate about what future periods are actually going to do. Okay. I want to talk about variable versus fixed expenses, and I know I mentioned this just a moment ago. As a general rule of thumb, you don't want a ton of fixed expenses in the business. Fixed expenses, I think a lot of times people feel like, well, fixed expenses are good, but they're good because they're easy to predict what it's going to be. I know what my number is, I don't have to guess. The problem is when business is not so good, the fixed expenses are still fixed expenses. So let's kind of dive into these a little bit. It says that fixed expenses refer to any expenses that do not vary with volume, and I'll say within a given range of activity. So if we were to think about payroll for management, right? Not for the employees, but the people who are salaried. I'm going to pay, say, $12,000 this month. If we have one customer, or if we have 100 customers, or if we have 1,000 customers, the pay doesn't change. The rent on my building, right? So if I produce one cog, my rent is the same, or 100 cogs or 1,000 cogs, it doesn't matter. My rent is always the exact same figure. So fixed expenses do not vary with volume, with the volume that the business is doing. So things like rent and insurance and salaries, very easy to budget for, but you want to be cautious about loading your business up with expenses that do not vary with activity. The other half of this is going to be variable expenses. And as you might expect, and as the name implies, variable expenses refer to expenses that will vary directly in proportion to the activity that the business does. So again, if I was selling these pens, I know how much a cap costs, and I know how much an insert costs, and I know how much this costs, and I know how long it takes me to put one of these together, and then I know what the packaging costs. I can go through all of those expenses of what I know it costs me on a per pen basis and say, if I sold 10,000 pens, it's going to be $10,000. If I sold 100,000 pens, it's going to be $100,000. If business falls off and I don't sell that much, well, then my expenses are going to go down. These are expenses that vary directly with volume or directly with activity. So things like hourly wages or consumables or the materials that go into producing whatever it is we're creating, these can be a little more challenging to predict because unlike fixed expenses, where again, I know my rent is $8,000, that's my rent, it's $8,000. I can project that out, it's $96,000 for the year. There's no questions there. This, I have to say, in order to predict my expenses, I have to kind of predict how much revenue are we going to do, right? How many cogs are we going to make? How many units are we going to sell? How many customers are we going to have? Because the expenses are going to be pretty directly tied to that. If I was to look at your business and if you did $100,000 in business and your payroll was 40,000 and you did 500,000 in business and your payroll's still 40,000, something's wrong there, right? So I would expect that if you did 5 times as much business, that it should go up. It doesn't mean it has to. You would say, no, Bernie, that's it, and that's fine. But that's typically how I might look at that, right? So fixed expenses and variable expenses. Everyone's got that down. Everyone understands the difference between these two. Leticia, go ahead. You're on mute.
Yes, I was notified Friday by the automobile insurance that they were going to be reducing that premium 25% because of the likelihood of not driving.
Right.
So then that got me thinking about our fixed expenses, some of which are premiums for insurance.
Yep. So
I thought the staff is now working at home, and if I'm not mistaken, we're paying for insurance to cover the office space.
Yeah.
So I'm going to give them a call tomorrow to see that really should be reduced drastically because we're not there.
Yeah, I mean, you might be able to push back. I'm not certain, but yeah, you can say. So, I mean, depending on the insurance policy, sometimes you would say, well, I want to put this on pause.
Mhm.
If it was your entire business, it might be a little easier than to segment it. I'm not sure, but that's exactly the point, right, of fixed expenses. Yep, absolutely. But the downside of it as well. There's another way that we can think about our expenses. Oh, I'm sorry. So this screen is kind of clarifying that a little bit. And so if we looked at it, our fixed costs are going to stay fixed and constant the entire time. They're not going to change, right? So they're down here. And so at 1,000 units, it's whatever this is, 180,000, and at 5,000 units, it's the same thing. The variable cost, though, if we do no volume, there's no variable cost. But as we are producing more volume at 1,000, this is going to be our total cost, 2,000, 5,000, and on and on. So this is a way that we can think about variable cost versus fixed cost. I do say within a given volume, because here's the thing. If we were actually to do, 1,000,000 units, well, 1,000,000 units, I'm gonna need a bigger warehouse, I'm gonna need more equipment, I might need more supervisors, right? So at some point, the volume will break the whole concept that fixed expenses don't change. So I always like to say they're fixed kind of within a given block, right? So once you get so big, I need a bigger warehouse, I need a second bulldozer, I need more people. Another way that we can think about our costs, and this is important, and we will dig into this, we'll unpack this quite a bit. This is probably one of the biggest areas where most people have with pricing their services. We can also break costs into two different areas, one which would be direct expenses, the other one which would be indirect expenses. Direct expenses refer to any costs that are generally they can be traced directly to whatever it is that we're producing. A specific job, a specific customer, a specific cog. They're very, very easily to assign. So we said like the pen cap, well, I know that I bought this cap, so if the whole pen was $1, if that's what it cost me, if this cost me 30 cents, I can tell you exactly where this cost went. It went into this specific pen. There's no question. And so some of the examples, it says direct labor, direct materials, supplies. This is usually pretty simple to assign so that we know where it went. And so we can usually, it's very easy for us to bill a customer for anything that went directly into it. I say, well, you had 6 windows and you had 2 screen doors and 2 regular doors. We can capture these costs very, very easily. There are other costs that are called indirect costs, and these are not so simple. Indirect costs refer to costs that are not directly associated with a specific item or service or customer or job. We would often refer to this as overhead, right? This is the money. These are the expenses of just running the business. It is what it is. Management, right? So your time, how do you allocate your time? Or the sales staff, how do they allocate their time? Or the office space, right? The office isn't associated, it's $8,000. How do we take that cost and allocate that? How do we recover that cost from a specific job? Or insurance, or marketing, or entertainment, maybe you can assign to a client account, but a company party. These are all costs that some are very, very necessary, others are arguably so, but the question becomes, how do we recover those costs? Your goal as a business owner is to recover 100% of all of the costs, plus hopefully some margin, because we want to put a couple coins in our pocket at the end of the day, right? And so the indirect cost is probably one of the most challenging areas for business owners to figure out. How do I price my services in a way that's free? Most of the time, I call it the poke and hope, right? So you set a price and you go, that's what it is, and we'll figure out if it was the right price. And if at the end of the year I didn't make any money, I'm going to increase it by, I don't know, pick an arbitrary number. That's the new number now. We'll see how this goes, right? But that's not a great way to approach business. You recognize that, right? So ideally, what we would want to do is understand what should be going into that, whatever our allocation strategy is. So we're going to talk about this a little more next class. Some direct expenses, as we said, would be things like labor and materials, consumables, fees, permits, excuse me. These are usually very, very easy to assign. One area, though, that is challenging or that I think a lot of people kind of overlook is with direct labor. And the reason is that direct labor often has to be adjusted for billable hours in order to fully recover it. So, for example, if we had an employee who we paid $20 an hour, after some, kind of small administrative burden, that's going to cost me $45,000 a year to pay someone $20 an hour. Well, if we look at it, I may say, well, here's the thing. I'm not going to bill you $20 an hour because you're only going to work 800 hours, right? That means that I've got to recover all $45,000 over a span of 800 hours, whatever I think my billable time is going to be. And that's key. People will say, well, I'm going to make my number $40 an hour. Well, guess what? If you divided this, $40 an hour would not cut it. You would be losing money. It would cost me money to send my employees to go work for you, okay? The cost to me is $57.20. That means that I break even. I didn't make a single penny on you. That is the point when I make absolutely no money. And the reason for that is if we take that $45,000 and divide it over the 800 hours that I think that I'm going to be able to bill you, the rate is going to be $57.20. That is my beginning rate. Does that make sense to everyone? Because that is a really important concept that I think is lost on a lot of business owners. Good, okay. The next group, indirect expenses, to kind of take a look at some of these, we have rent and marketing, right? Those aren't going to change or shouldn't change with volume. Licensing or indirect labor, office supplies, marketing, insurance. I have marketing on there twice. That's how important it is. These expenses generally will not change, but here's the challenge. We've got to figure out how do we bill for those expenses, right? As a general rule of thumb, clients do not want to pay for any of this, but they're all necessary to run the business. And here's the thing, I can't eat these costs. I would go out of business very, very quickly, and that's not going to help anyone. So we've got to figure out how do we recover those costs. Typically, this is done through something that is called an allocation or an allocation strategy. How do we allocate our indirect overhead to our billing rates or to our client projects? Says that this here requires an estimate of activity levels to recover costs. And so if we were to look at this, an example might be, we think that our total overhead for all of this is going to be $100,000. I think that I'm going to have 1,000 jobs this year, so that's my guess. Well, I can say if I'm going to have $100,000 in overhead and I'm going to do 1,000 jobs, I need to recover $100 per job to break even. So that does nothing to it. So if I put an employee in a job and that employee is going to work 10 hours, I'm going to bill $57.20 for the 10 hours, and I'm going to add $100 to that. I'm going to charge $627 to have that employee who makes $20 an hour on the site for 10 hours. This is the reason why we are trying to recover all of the costs. The allocation strategy that you choose will be whichever strategy is most palatable to your clients. It says here that the allocation can be made in a fixed amount, meaning $100 a job. It can be by a percentage, meaning 10% of the job we're going to add on top of that, or by some other method or any combination, whatever we think is going to be most palatable to the client. So a lot of times what we may do is I may mark up my labor Maybe I charge twice the labor rate. I'm also going to mark up my materials by 100%. And from there, I think that I'm going to recover my costs. So that might be a strategy. And we will dive into that in a little more detail next week, or I'm sorry, on Wednesday. So I already touched on this. So assets and expenses. So an asset refers to anything of value that is owned by the organization, or that is, if it's not owned, that is at the organization's disposal, meaning that we can use it anytime that we want. Expenses refer to any expenditures, right? So usually monetarily, but doesn't have to be. And so some of the things that we want to think about is that some of the expenses in the business don't always hit the cash flow statement. So for instance, very much like Leticia was pointing out, if I gave my insurance company $10,000, or let's call it $12,000, we'll make it a nice even number, but I was to cancel my policy in September, at the end of September, theoretically, and it depends on the insurance policy and how it's written, but I should get $3,000 of that back. It hasn't been used. If I was to cancel it in January, after 1 month, I would get $11,000 back. So that money that I've put out there, I've basically taken an asset from being $12,000 in cash, and I have converted it to a $12,000 prepaid expense. That's what we would call it when I pay my insurance for 1 full year out. That is called a prepaid expense. I now have a $12,000 asset on my book, and every month I'm going to decrease it by $1,000 because I have used 1/12 of that prepaid asset. And once we get all the way to the end of the year, I will write down the last $1,000 and I will say that the asset, the prepaid prepaid expense has been completely utilized, right? So it's gone. So some examples of this include prepaid assets, investments, or capital purchases. By the same token, if I had a $500,000 in the bank and I put it into the market, that's not an expense. I've made an investment in it, or if I bought another company or did something like that, it's an investment. Those are not expenses. And so this is just the example that we were talking about with the insurance policy. So something to understand. What we were just doing with the insurance policy is something that we would refer to as depreciation. And again, something that I think a lot of people have heard the term, and when we conceptually understand what it is, it says that depreciation refers to the lessening of value of some asset over the asset's useful life, or whatever we suspect the useful life to be. There are a number of ways that you may be able to expense something. I would encourage you to talk with your accountant about it. Typically, straight line depreciation is one of the most common ways that you could do it because it's very simple. And what that means is that if I had a $10,000 asset and I thought that at the end of 5 years, it was going to be worthless. It would be absolutely worthless. It was going to have zero value at the end of 5 years. What I would say is that every year I'm going to reduce it by 1/5 of that value. So it's $10,000. I'm going to reduce it by 2,000, by 2,000, by 2,000, 2,000, until finally the value of the asset is now at zero. We would call that depreciation, and the fact that it's the same all the way across, that is called straight line depreciation. There are other methods. There's one that is called double declining. And what that says is, well, Bernie, that's stupid. If I bought a $10,000 truck, the biggest depreciation happens in year 1, right? So maybe we're going to depreciate it by $5,000 in year 1, $3,000 in year 2, $1,500 in year 3, right? And on, because at the end, the asset is nowhere near as valuable as it was at the beginning. And that's certainly true. There are certain rules about how the IRS will allow you to do this. And so again, I would just encourage you to talk with your accountant, but understand there are different ways. So the IRS governs the rules for how assets can be depreciated, as well as their useful life. So you can't say, well, yeah, I just spent $400,000 on a building and it's got a 1-year useful life. The IRS is not going to let you do that. They're going to say that it has to be depreciated over 30 years, and a vehicle typically has to be 5 years or 7 years. And, if you were spending, if you were a large corporation, you're going to spend $8 million on computers this year to outfit, your whole building with all new computers. They're going to say, well, that's going to be 3 years, and furniture and equipment are going to be 5 years. Like, they'll have all of these different rules on when you can expense something, or the depreciation schedule, the useful life. And so typically what you're going to do is, for every asset that you purchase, you're going to create what's called a depreciation schedule. I'm going to list every year what that asset should be worth, and then what it's going down based on however I'm going to depreciate it. The reason I want to do this is I'm going to take those expenses at the end of the year. We're going to touch question. Yes, ma'am.
How do you determine the percentage of the depreciation on items? Like, do you just have to go through the market to look it up, or?
So typically, here's what you would do. And I think no matter what, you can rob Peter to pay Paul now, or however you want to do it. When you set a depreciation schedule, what you do, this is my vehicle. This is $100,000. I think that I'm going to have this for 5 years. The other part of creating a depreciation schedule is that you need to create an estimate of what is going to be the residual value. That means that when I go to dispose of this asset, will I get any money back for it? So let's say that this was going to be a $100,000 asset. I'm going to make the math simple on myself. It's a $100,000 asset. I believe that I am going to be able to use this for 4 years. At the end of 4 years, I am going to sell this. I am confident that I'm going to get $20,000 for it. When I'm done, I'm going to sell it for $20,000. So I'm going to say that in that 4 years, I only expect the value to depreciate by $80,000, not by $100,000. Okay? Because I think that I'm going to get $20,000 back at the end of it. What I would do is for year one, I'm going to lower it by 20,000, 20,000, 20,000, and 20,000. And at the end of that 4 years, what is referred to as the book value is, what does my accounting system say that this is worth? The book value hopefully matches what I'm going to get for it. If it did not, let's say that you got $40,000 at the end of this instead of 20,000. It held its value really well. The government, the IRS, is going to require you to record a $20,000 gain on your books, because it allowed you to write it down, right? You wrote it all the way down to 20,000. And so if you sold it for 20,000, you'd be fine. But if you sell it for more than 20,000, you're going to have a gain. On that same token, if you only got $10,000 for it, you can write off an additional loss on the sale of an asset of $10,000. So no matter what, you're always going to have that reconciliation at the end of this. Does that make sense? Okay. And so we'll develop depreciation schedules. The price that you put for this should be the all-in price. And what that means is what it cost me to buy this, what it cost me to ship it to my location, everything that I spent to get it started, everything I spent to install it, to mobilize it, to train my people, all of that. All of those costs can be wrapped up in this particular asset. Most people choose not to do that. And the reason that they choose is they say, yeah, no, the training time, that's an expense. I'm not going to capture that cost. I want to expense it. I want to lower my tax burden at the end of the year. I want to tell Uncle Sam I had a ton of expenses, right? So a lot of times companies may choose to expense that rather than wrap it up. So this is what we were just talking about. That all-in purchase price that we came up with minus our estimated salvage value, that is the depreciable value. We're going to take that depreciable value, we're going to divide that by the number of years. That's going to be our depreciation for each year, assuming we're going to use the straight line method. So we said straight line is the most common, and so right here, that depreciable value that we just came up with divided by our useful life gives us the expense amount for each period. As we said, any variance will be recognized as either a gain or a loss on the sale of the assets. And it says here that the IRS may have special, and I like to say an ever-changing rules because they do change every year, that allow you to expedite the expensing of assets. So there are some times that they'll say, so like there was a very common deduction that is called a Part 179 deduction. And if the asset is less than X amount, or I don't know how they actually determine, I'm not an accountant, but you can just take the whole thing right now if you wanted to. You could take the whole 80,000 this year. It's called the Part 179 deduction. Why would you want to do that? Well, the business made $100,000 profit after I paid myself. I'm going to owe taxes on that $100,000. If I could say, oh, no, wait, I actually had an $80,000 asset. Now Uncle Sam's going to go, oh, okay, I recognize that you only owe taxes on $20,000. And that's going to be a lot more favorable because you're all business owners. You recognize that we pay a ton of money in taxes after the fact, right? So we're probably only keeping about 4 dimes out of every buck we make. So as much as possible, we want to try to control that tax liability. This is what, so again, we referred to something as the book value, and the book value is whatever your accounting system says that the asset is worth. I bought it for $100,000. I'm going to sell this. I'm going to depreciate it by $20,000 each year. At point 0, when I first bought it, the book value is going to be $100,000. After 1 year, the book value is going to be $80,000. After 2 years, the book value, does everyone get that? The book value tells you what has yet to be expensed on a given asset, right? What is the value of this if we were to get rid of it today? And anytime that you sell something for more or less than the book value says, you'll either record a loss or a gain on the sale of an asset. Simple enough. As I said, Uncle Sam is pretty particular about what the useful life is. And so we see here that if it was fencing, they would tell you that it's 20 years, science and engineering equipment is 10 years. Where do they come up with these numbers? I don't know, but they will typically tell you what the depreciable period is, right? So this is the least amount of time that you can depreciate it. You can depreciate it over more time if you wanted. They don't care about that, but you cannot do it unless without a good reason. So managing the tax liability, I said, really is something that is important. And so we like to say that, one of the only 2 guarantees in life, right? And death and taxes. No matter what, we are going to pay taxes. While tax laws or rates do vary depending on the type of organization that you have. And when we say the type of organization, what I mean is, are you a sole proprietor or a partnership? Are you a corporation? Are you a limited liability company or an LLP? No matter what, Uncle Sam is going to get his cut. It just depends on what the type of organization that you have will determine what and how you pay taxes on money that the business earns, or I should say money that the business keeps after it pays its expenses. I want to be specific about that too. Your tax burden will be calculated based on the profit of the business. That is very, very important to keep in mind. I think that it's probably obvious, but just at the risk of stating the obvious, the business will only pay taxes on whatever the profit of the business is. Many business owners and their advisors will always be looking for strategies to lower your tax burden or mitigate your tax burden. And so they may think about different things that they can do with revenues, right? So that where they say, well, I would not complete that job until January, and that's going to get you a whole nother year. I'm not advising any of this. I don't give any tax advice, right? So I'm just saying something that I read in a book once. So they might say, well, instead of recognizing this revenue, if you were to finish the job on January 15th rather than December 30th, you could book that as a 2020 expense. The right way to do it, the legal way to do it, would be to book the portion of the job that is done up until that point in time, and you would book 84% of it, and you'd book the other 16% in January. A lot of times for smaller businesses, for simplicity's sake, they might keep it all together, and maybe they try to push it to the next period, because if the revenue is in 2019, I'm going to owe that money in April. If that money didn't come in until 2020, I've got a year from April in order to make that payment. Does it make sense to everyone? And the same thing with expenses. Excuse me. It's just an itchy throat. That's all that is. Don't panic. The same thing with expenses. If I had an expense, most of the time at the end of the year, businesses will look anything that I think that I'm going to buy in Q1. I will typically buy during the November and the December timeframe. So Gabriella, my assistant, is on the phone right now, and so we get a new printer and we get this and all of those things that I think that I'm going to need in the first 3 or 4 months of 2020. December is the best time to get them. I can take all of those expenses and I can dump those into December to reduce my profit so that I only owe taxes on whatever that new number is, right? So I'm going to spend it anyway. It's not like I'm spending money. I'm not trying to dump money, but I know that I'm going to need it. I'm going to spend it anyway. So we want to think about a timing opportunity for things like that as well. In order to mitigate our tax liability, as I said, we may look at our revenues that we report, particularly near the end of the year or the end of a period. Gabby just texted that she wanted to get fake plants and I denied her request in December. So I guess you don't get everything. So nobody likes my plants in the office, I guess. But so we can look at, what is the timing of revenues as well as expenses at the end of the year. And so, when do we make that purchase? The business owner's aim, and again, I'm not giving any tax advice, is to reduce their revenue, increase their expenses. And both of those strategies have the same outcome of reducing your year-end profit, which has the outcome of reducing your tax liability, what Uncle Sam is going to take from you, at least in April. You're truly just kicking the can down the road. But we know that one of the first golden rule of money, and this is true, is that $1 received today is always worth more than $1 received tomorrow. And what that means is that $1 that I can pay tomorrow is much better than $1 that I would have to pay today. And that truly is very good financial advice for any business. So ideally, I want my money as soon as possible, and I want to pay you as long as possible. You've noticed that a lot of your vendors are paying you slower and slower. You are financing their operations for them, right? And so we are always very quick to want our money, and we'd like to pay as slow as possible. That goes back to the rule of money. In the event that we had a loss in a given period, so if we lost money this year, we can carry that loss forward into future years to offset income. So let's say that in 2019, our business lost $40,000, and in 2020, my business is going to make $100,000. I can take that $40,000 loss and carry that forward into 2020 to lower my income for the year. Okay, so losses can be carried forward from year to year to offset income. All right, I'm going to talk about a few strategies. Actually, this is probably a good time to break, because what I'm going to do is I don't want to break in the middle of this. We might finish up a little after 8, so it won't be too long this evening. But why don't we take a break now instead? So it's 7:17. Why don't we take an 8-minute break? We'll come back at 7:25. Is that okay with everyone? Before we go, any questions from anyone? Carolyn?
Yeah, my question is I'm a sole proprietor, and how will my taxes be affected by becoming an LLC? I'm not sure if I'm asking that right, but I've heard pros and cons about it, and I know that is to protect me becoming an LLC. But how would my taxes be affected, or in the way I do them, or write off expenses?
So as a general rule of thumb, I would tell every business owner that you should either be incorporated or be an LLC. The legal indemnification that it offers you, the insulation from things that happen, I mean, just that alone should be enough reason. But there are tax benefits that can go along with it. As a sole proprietor right now, the business doesn't make any money. Everything essentially flows onto your personal tax return. And what you're going to do is you're going to start by all of the money that comes in, you're going to pay self-employment taxes and income taxes on. You can't really avoid that, at least not for all of your income. But what you can do is if you were to be an S corporation, you can shield a portion of your income from those self-employment taxes. And so it's 15.3%. That's a big number that you would not have to pay. And then after that, you'd also have to pay income tax on everything that you made. So the first 15.3% is going to be your half of Social Security and Medicare, as well as Uncle Sam's half of Social Security and Medicare. And then after that, you're going to pay your income taxes. If you were to be a S corporation, or if you were to be a limited liability company and filed the correct form, I think it's like a 5295 or a 5395. What it is that the title of the document is an election by a limited liability company to be treated as an S corporation. If you were to file that document with the federal government, that would allow you to essentially treat yourself like a S corporation without having all of the requirements that go along with corporations. Things like having bylaws and having annual meetings and having being required to have like a board of directors. I'm not saying they're bad ideas, but there would be no legal requirement for you to do any of that stuff. And you could still be treated the same. What you can do is, if you are being taxed as an S corporation, the IRS requires you to take what they're going to call a reasonable salary. That is the only thing that it's defined. I'm going to tell you that whatever the profit of the business is, you probably want to, as the owner or owners, be paying yourself at least 60%, maybe a little bit more right there, right? So 60, 65%. The 35%, you can be taxed differently on that. So that 65%, you are still going to pay your self-employment taxes, and that's going to be treated normal, just like any other income would be. But the rest of the money can be subject to like capital gains tax, where you would pay a flat 15% tax on that. And it depends, Carolyn, because I think that sometimes it flows under your K1. Again, I'm not a tax guy, but there are tax advantages for corporations. So you may be able to shield some portion of your income from certain taxes, specifically those self-employment taxes. But 15% is a big number.
Yeah, it is. I appreciate that.
Yep.
Thank
absolutely.
you. Good to know.
Any other questions? All right. Well, I tell you what, I talked for a few minutes here, so we'll still. It's almost 7:20, so we'll take 10 minutes. We'll come back. Okay. All right, we are ready to jump back in.
Okay, Skipper.
All right. All right, so the next topic that we really want to talk about is how does the company finance its operations? There are generally three different ways that you can finance the business. One of them is to finance business operations through the use of your own money. So you've got money in the bank, and ideally, that's probably a really, really good way to finance the business. We'd call it self-financing. So if there's something that you wanted to do, the next question is, how are you going to pay for it? Other options, though, that we have, and options that are very, very common, is we can also use debt or we can use equity to finance our business operations. And we're going to take a look at these. So use of existing funds, I already said, is called self-funding. And this means that we are using the existing cash in the business to pay for something or to finance our business operations. It says that this is ideally, or this is the most ideal approach. It's not always advisable, and some of the reasons may be, for instance, right now, I think that there's probably some uncertainty with what's going to happen in 2 months, 3 months, 6 months. And so we may say, well, we'd rather reserve a little more cash in the business because I don't know what the outcome is going to be of the current situation. And so this is also viewed very favorably by third parties. If you were to go to the bank and ask for a loan, and you say, well, for the most part, we're self-financed, or somebody was looking at the business, this would be a very, very good thing. It says that the business is generating enough cash or has enough cash on hand to sustain itself. This says that it requires the company to maintain sufficient capital to meet maturing obligations while also having enough money to wait for their payments from customers. Sometimes it could take 10 days, 90 days, 180 days, or longer, or never, right? And so we've got to make sure that we've got enough money there. Sometimes this is referred to as covering the spread. It means that I can pay all of my bills while waiting to get paid from my customers. There are times that I will meet with a client and they're struggling and they're always out of money, and I look at the amount of money that they're pulling out of the business and it's just too much, right? So once the business makes money, you can take it out anytime that you want, but it's very difficult to actually grow the business if you keep on stripping everything that you make out of the company. So we need to make sure that we've got money to allow the business to grow. In the event that we cannot finance the business ourselves, we may turn, as I think is very common, we may turn to debt. Debt refers to the use of funds which are borrowed, and borrowed is the key word here. Borrowed from a third party, such as a bank, credit card, personal loan, or an alternative lending company, typically at some rate of interest. It says that this also includes lines of credit once funds have been drawn from the line of credit. And it says that there's a variety of debt vehicles. When we say debt vehicles, how can I borrow money? Well, one way is a loan. We can actually sell bonds in our company, which are kind of thought of as a bond, thought of as a loan. We can have revolving credit on our credit cards or with certain accounts. Debt is not viewed anywhere near as favorably as being self-financed, but it is necessary from time to time. As a general rule of thumb, even if you're investing in your business, so you've all heard of the bond market, right? They say invest in the bond market. The bond market is safer than the stock market, and generally it is. The reason is that the stocks, if you have a stock in a company, that is considered equity, which we're going to talk about here in a second. A bond is considered a loan. The loans get paid before any shareholders in the company get paid. So loans are always paid before stocks. And so they're generally viewed as having much less risk than the stock market. And this is true, but they also have a rate of return that is significantly below the stock market. So that risk return trade-off is always there. We can also finance the business operations through selling equity in our business. And what this means is I essentially bring on a partner, however size, whatever we decide that partner should be. I am selling some ownership interest in the business so that I know that I need money. I need $50,000 and either I can't take out a loan or I don't want to take out a loan for whatever reason. I can bring Cersei in as a partner in my business. Cersei gives me $50,000. I sell her $50,000 worth of my equity in the business. And now Cersei is a partner, 10%, 20%, whatever the percentage is that Cersei buys in the business. Anytime that you are buying the stock market, this is what you're buying. You are buying equity in a company. So if you have a share in Coca-Cola, you are a shareholder or an equity holder. You actually own a piece of the company. That share represents some portion of it. It says here that the use of equity refers to the use of funds that are accepted from a third party, such as investors, partners, even the current ownership, in exchange for some additional ownership in the company. There's a variety of approaches that you can take to sell equity in your company. We can sell common stock or preferable stock. We can have callable stock. Callable stock, I think, is pretty common. What that means is that I'd be happy to take your money and give you an ownership in the business, but I can buy that back from you anytime that I want. That stock is callable, right? And I think a lot of times this is how businesses will sell money, equity in their business. Another point that it has here, it says that owners should take care to maintain control over the company itself, right? And so control in a corporation means that you own 51% or more of the corporation. And once you lose that, even if you have 50%, you no longer have ownership. Let's say that I maintained 40% for myself and I sold 10 other people 6% each. Theoretically, those 10 people could get together, and if those 10 people agreed, I'm not making the decisions anymore, right? So you want to make sure that you are keeping a controlling interest in the company. And so if you are selling equity, this is generally viewed the same as self-funding, which means that banks look at it very, very favorably. It doesn't matter where you're getting the money. You're not borrowing it from anyone. And that's really what the banks care about, right? So they're going to look at how far leveraged are you? That means how much money have you borrowed so far? The owners in a company, so why would somebody want to buy an interest in your company? Well, there's a few reasons. The ownership in a company typically is going to profit one of two ways, and this is going to be the exact same thing. Once again, if you own stock in a company, you can either profit through dividends, which means that each year or each quarter the company is throwing off some portion of money and they're giving you some payment on that, as well as what we would refer to as capital appreciation. Capital appreciation means that the asset that I purchased is now worth more than it was before. So let's say that I bought a share in Coca-Cola. Here's my share in Coca-Cola. I buy this for $100. Over the course of a year, Coca-Cola issues 4 dividends of $2.50 each. So I've made $10. I've made 10% in dividends. Plus, there was some good news which came out, and now this one share of stock is now worth $110. I can look at the end of that year. If I was to sell this one share of stock, I would have made a 20% return on that because I got $10 in dividends plus $10 in capital appreciation, okay? So that is the reason why someone would want to buy an interest in your company, both for the dividends that the company is going to throw off, as well as capital appreciation, which means that the value goes up. The value of the business typically will go up as long as you don't take money out of the business and as long as you are making a profit at the end of each year. Every time, if I was to take $100,000 out of my company as an owner's draw, my company's now worth $100,000 less than it was before I took the draw. That makes sense, right? And so when you make money, there's two things you can do with it. You can leave it in, the value of the company goes up, or we can pay the money out in dividends, the value of the company goes down. Does everyone understand options for financing the company? Right now, there are some pretty unique things going on, and I'm not by far an expert, but there are some unique loan opportunities that are out there right now with the PPP and the EIDL loans and advanced loans and SBA relief packages and things like that. The state of Illinois got some, Cook County has some. So, but these are all still nonetheless loans, with the exception of the PPP, which does have the possibility of turning into a grant. In the event that you were to receive a grant, you don't pay that back. So if it is forgivable, as they're saying it is, that would be referred to as a grant. One other way, and I do not call this one of the three ways to finance a business, but it is by all means a very real option. You can use something to finance your business that is called factoring. And I have a client who does this, and I would love to get them off it because it's not a great practice. Factoring means that we are selling our accounts receivable so that we can get our money sooner rather than later. But if you think about it, the factoring company is obviously going to be taking some portion of that money for allowing us to do that. So instead of waiting 90 days to get my money, I can sell my account receivables to HACIA. HACIA is going to give me 94% of the money up front, and she's going to take a 6% cut for waiting on the money, or whatever the figures are, right? But that 6% is a pretty big number because it's only 3 months, right? If she's getting 6% every 3 months, it's 24% a year. That is a big number that you are paying. Oftentimes, companies may use factoring when you're kind of in a bad situation right now. You've got to get your hands on money. I say that it's typically a short-term strategy. Most factoring companies will not allow you. I can't just sell you these 3 accounts. Either you do it with them or you don't do it with them. You'll sign a contract saying, I'm going to give you all of my ARs, right? They're not going to just allow you to give them the crappy account receivables that you can't receive from. And you are typically still on the hook for the final receipt of those. So getting financing for the business, I'm going to give you the golden rule. If you take something away from tonight, it should be this. Everyone wants to give you money when you don't need money, and no one wants to give you money when you do need money. And that is the absolute truth. Your available options for bringing money into the business generally become fewer and fewer, and they become more and more expensive as the business factors deteriorate, right? When are you most likely to need money, to seek money? When things aren't going so well. That is the worst time that you could possibly go ask for money. It's going to cost you so much more than if you had just gone and sought the loan when the business was doing better. And so I will tell you, the absolute best time to ask for money is when everything is going swimmingly, right? And you don't need the money. What I would propose is that you go and get a line of credit for the business. A line of credit may be secured or unsecured, but it is a advanced loan that you can take. It gets you access. So let's say that you had a $100,000 line of credit. That means that anytime that I want, I can draw from that $100,000 to finance my business operations. So I have a line of credit available. It is a very nice safety net, but I don't pay any interest on it, and it does not show up as a liability until I take a draw. If I was to pull $10,000 out of my $100,000 line of credit, I am only paying interest on the $10,000 that I pulled out. Also, it is only going to show on my books that I have a $10,000 loan. Does that make sense to everyone? So once I pay that $10,000 back again, I still have a $100,000 safety net in the event that I need it. There's a general rule of thumb, those lines of credit will be at a much more favorable rate than like a credit card. Some of your credit cards, look at your credit cards, right? You might be paying 12% or 15% or 18%. Those are some pretty steep figures. You may be able to get a line of credit at 4% or 3.5%, which are pretty favorable. When we talk about secured and unsecured lines of credit or secured and unsecured loans, just so you understand what that term means, a secured loan means that you are backing it up with property or other assets. It means that you are offering collateral on the loan. And so I may say, well, I'm going to use my home to secure this loan. I'm offering my home as collateral. If for any reason I don't pay and I owe you $80,000, you have the right to come in and take my home, sell my home. You'll take your $80,000 plus any selling expenses, and then you'll give me the rest of the money from there. An unsecured loan means that I'm not backing with anything. If you're out the money, good luck trying to collect it, right? The trade-off there, because everyone will go, well, yeah, I'll do the unsecured one. That sounds like a much better deal for me, right? The trade-off there is that an unsecured loan is more expensive. As you ask the bank to take on more risk, the loan will get more and more expensive. So a secured loan is almost always cheaper than an unsecured loan. I do recommend that all businesses have a line of credit. Again, it will shield you in times when the business is not doing so well, and it's better to ask for it when you don't need it. Third-party evaluations will review your financial statements and your profits to determine whether or not your business is bankable. This will be a term that you will hear. And any time that you are bankable, that's where you should go get your money from, is from a bank. It is going to be the cheapest and the fairest option for you, rather than going to what I would call alternative lenders. Alternative lenders are things like factoring, or I've got a guy who can probably get you money no matter what, but it's going to be really, really expensive, right? So if you are bankable, that is your best bet. In the event that you do plan on going for financing this year, you want to be careful about, you don't want to say, well, that's great, I mitigated all of my tax burden, but I lost $50,000, so that's terrific. The bank's going to look at it and go, you lost $50,000. You go, no, I didn't really lose $50,000. I was only doing that for taxes. The bank's going to go, you lost $50,000. That's it, right? And so you want to think about, if you see a need to finance the business, you want to be very, very cautious about what it is that you write off in the preceding year. Okay. One of the last topics that I want to touch on this evening is going to be reconciling cash to accrual systems. As I said, accrual systems will recognize the money right when the money comes in. However, you may not get that money for quite some time. Because that's the case, you need to you need to account for what I still am going to spend my money the same. I'm just not going to get the money back into the business. And so a cash to accrual accounting, reconciliation is necessary for you to project what your cash flow is. We've heard in the past that cash flow is the lifeblood of the organization, right? If we don't have cash, I know businesses that are tremendously wealthy with their receivables, but they have absolutely no cash. They don't have any money that they can pay out, and that's a tough situation to be in. We've probably all had a cash crunch in the past. You say, if I could just get this client to pay me $80,000 that they owe me, everything would be great. And sometimes it's more than that, right? There was a period of time when the Illinois Tollway could not pass a budget. If you remember that, or I'm sorry, not the tollway, but the state of Illinois could not pass a budget. A lot of people went out under because of that. They couldn't float it anymore. So accrual-based accounting does require business owners to track their anticipated cash flow separately. So when do we think we're going to get the money in? Business owners must consider not only what's coming in and when it's going to come in, but what's going out and when that's going to go out. And that time frame in between, we need to make sure that we have either sufficient funds on hand to cover that spread, or we need to make sure that we have access to some type of a line of credit to cover that spread. You know, and looking forward, again, that goes back to that budget. You know, there are companies, and I'll run the numbers and I'll say, listen, you have got to do something. The best time to make a change to correct the course of the business is as soon as possible, not waiting until the last minute. There are some businesses, you've gone past the point of no return. I can't help you anymore. If you came to me 6 months ago, we could have made some changes in the business. We could have forecasted and made some changes in the business to try to get you back on track. So this says here that at a minimum, the business should be forecasting 6 months out, and that should be rolling in nature. And when I say rolling, is I'm 6 months out, and next month I'm going to budget 6 months, and next month I'm going to budget. So I'm consistently looking forward 6 months out, and I'm going to use my best guess. That is the best information that I have available to me. Do I know for sure? No, but putting something in there is always better than putting nothing in there. Advanced forecasting, as I shared, will allow the business owner to take appropriate steps to ensure that the business does not run out of cash. And again, that will crush you immediately. So, you know, I think that having the budget that we talked about earlier in the class, again, I don't know how you're sleeping at night without having some type of a budget. I would imagine that you just wake up, you know, like, I don't know when I'm going to make it. I have no idea what things are going to be in September or October or November. So we want to make sure that we are trying to do our best to think through that. When we are choosing to pursue a project or accept a project, those cash flows, that is going to be the key decision maker. And what I mean by that is there are times when I may have an opportunity to go after a $200,000 project, but here's the thing. I know that if I was to go do a project with the city of Chicago, my first payment is not coming for 5 months, probably, right? Maybe 6, maybe longer. And then once they get you set up, the funds will come a lot sooner, but it's just that first payment, and they tell you that they're setting up your billing instructions, right? And they're saying, well, we need this form and you've got to fill this out and send this over to this organization and contact this person and do all of this. Well, that's a long time for a small business owner to sit on 200 grand. And so you want to make sure that you're able to do that. Just because I'm not getting paid doesn't mean that I still have to pay my employees. I still have to pay my rent. I got to pay my utilities. I got to pay my insurance. I got to pay all of the other expenses. So just because I'm not getting paid doesn't mean that money is not still going out the door. We may look at a really good opportunity and I may decide I can't, I would love to, I can't, I'm not going to be able to cover that spread, right? I'm not going to be able to float the project for that period of time. We're going to have to pass. Does that make sense to everyone? So you want to make sure that the time frame, the timing of when you are going to get the money is not, there have been, and this is the honest to God truth, there have been companies that have been put out of business because they went after the greatest project that they ever had, right? And it was a great opportunity and everything would have worked out great, but they were not able to sit on, they couldn't cover it, okay? So you want to make sure that you're able to do that. A bit of a shorter class, and what I did is I pulled a few things out into next week. Any questions from anyone on anything that we touched on here?
Great information as usual.
Oh, thank you, Richard.
Critical. Having the right info.
Bernie,
Yes.
I have a question. Going back to the QuickBooks section, everything that we're doing, everything that is doing needs to and must be inputted into all the different categories. Can they be related to one another? Let's say it's a project.
Yes.
And
yep.
So everything that's just one project, it's a big folder just for that project. Everything will be related.
Yep. So, yeah, what a great question. Is this Alma?
Sulma. Well, so Alma's here too.
Yeah, I'm
Oh, hi,
here.
Zulma. Hi. The answer is yes. What you can do is almost every accounting program or every accounting program I've ever used will allow you to set up something that is called job codes. And what a job code is every revenue that comes in, I can assign it to that job code. And every expense that goes out, I can assign it to that job code. I can run not only my standard income statements, but I can run an income statement, a profit and loss statement on a given job, and it will tell me all of the money that I've made, whether or not that job is actually profitable. Does that make sense?
Yes.
And so if you open up QuickBooks or again, the Sage products, and I would suspect that absolutely any accounting software is going to give you some ability to add job codes.
Okay, adding job code. Yes, that would be way easier.
Yeah. And so when we come in, we're going to talk a little bit. I'm going to do my best to not step on any toes to talk about job costing. But what we're going to get into on Wednesday is we're going to be talking about how do we price our services for a given job. So when we go out, we've got to figure out how do we actually price this. And specifically what I'm going to get into, I'm not going to get into how do you estimate materials, but what we are going to talk about is, again, those figures that I talked about, those cost allocations. How do we make those cost allocations so that I know how I should be billing people? I have clients who every year they say we need to set our rates. They set their rates every single year, and we go through this whole process of helping them figure out what is their allocation strategy. The other part that we're going to talk about is going to touch on project management a little bit, but we're going to talk about something that is called EVA, which is earned value analysis. And so specifically, once we price a job and we come up with a budget for a job, how do we actually control the job to make sure that we're on target and we're spending what we think we should be spending?
Mm-hmm.
Oh, quick question, Bernie. Of course, this is very new to me. I have a question regarding pretty much what Alma was saying. So within the QuickBooks, so each job has its own folder, and this is my understanding. So each job that is done has its own folder. I guess with expense reports, correct? I guess what I wanted to know, like, how does that accumulate to the I guess the accumulative jobs at the end? How do they mesh? How do you end up getting a certain number of profit? How do you outline that profit status?
So let me make sure that I understand 100%. When you say that each job has a different folder, are you referring to a physical file or are you referring to a folder that is in QuickBooks?
File or yeah, that's what I mean. Is that how QuickBooks work? Will it be an individual filing QuickBooks or?
Yeah. So no, it will not be an individual file. So you will have a single accounting system. So you'll have your project file, right? So all of the invoices that we've written and all of the expenses that are associated with it. When we enter a revenue in QuickBooks or in any accounting software, typically what you have to do, you're going to have to enter a date, an invoice number, an amount. And with the amount, you can enter just the amount, or you can enter a quantity times the unit cost, and that'll come up with it for you. You can calculate taxes, it'll do all that for you. You should select a revenue account. There are some companies that have one revenue account, great for you. There are other companies, they have some for training and they have some for guitar sales, right? And so you're gonna wanna select the right revenue account for all of that. All the way over to the right, typically there is a job code for each one of those line items, right? And so I can assign the job code to a line item. What that does is it gives me a way that later I can actually filter. I can show all of the revenues that are associated with that job. And the next invoice is a completely different job. I'm going to enter a different job number on there. Are you with me so far?
Yes.
I'm going to go do the exact same thing with the expenses. Every time that I buy something, maybe I went to Home Depot and I ended up buying 100 bags of mulch. 20 bags of mulch were for this project, 20 bags were for that project, and the other 60 were for this project. I can add, even though they're all on the exact same receipt, I can break that up into 3 different line items, and I'm going to put the job codes next to it. Because I have that same ability to add that filter, I can run what is called a job report. When I'm going to go to the top, I'm going to go up to reports, I'm going to hit job report, and it's going to say, what job do you want to see? And I'm going to say, show me all active jobs, or I'm going to enter a job number. When I enter that job number, it's going to filter out everything in my accounting system that does not have that job code. So now I can run a profitability report on nothing but that job. So I filtered everything else out. When I want to run everything, I just get rid of the filter and I say, I don't want a job report. I just want to see a standard income statement. Show me what the income statement looks like. That's going to combine all of my jobs and also anything, even if I didn't put a job code, that's going to show me all of the income and all of the expenses. So I can very quickly look at the business from 2 different angles. Does that make sense?
Yes.
Yep. You know, with your receipts, I'm a bit of an organization geek, but I'll tell you that, you know, I've transferred a lot of this to Gabby, who handles all of this for us. You should take care to keep your receipts. I number all of my receipts. If it has an invoice number, great. But even if it's a credit card, we give all of our credit card numbers. And so when I get a credit card, I'll always put CC on there. And I'll usually put the year dash, the month, and then I leave it like that. And then I'll give that to Gabby. So Gabby will walk in, and everyone in the company who spends money on cash basically leaves their receipts in a specific spot. Gabby will go through twice a week, and she'll take all of those receipts and she'll enter them into the accounting system. That last digit, once she enters it, Gabby assigns that last number. And so, for instance, if I was to spend something, if this was the 6th credit card receipt that I had in the month of April, it would be CC 20-04-06. Okay. At any given point in time, I know where that receipt belongs. I know when the money was spent. The number 6 just means that it's the 6th receipt that was spent that month. What Gabby does is she tapes all of them to a sheet of paper. At the end of the month, she staples it. April of 2020 is going to go in a folder. At the end of the year, she takes all of the months and puts them in a book. Having your receipts handy will be, especially if you are doing work for clients, will be more important. We don't spend a lot of money on behalf of clients where we're primarily a service-based company, but people will come back and ask for that, or in the event that you are ever audited. I had a client who was audited 3 years by the state of Illinois. Gabby, I don't think you were here when we had this audit, but so we had probably 6 or 7 boxes of paperwork, and I mean just solid paperwork. And this woman came and sat in the office for 9 days and went through every single sheet of paper. And at the end of 9 days, I think we owed $138 or something like that. And parts of it were for, we bought something from out of state. And if you buy something from out of state, I apologize if I already told this story, but we bought something from out of state and we didn't pay end user tax on it. You're supposed to pay end user tax. They had one sales tax report where they were off and there was a penalty on there of like $9 or something like that. Where I'm going with this is after 9 days and pouring over 3 years of information with a magnifying glass, that is all that they found. That's because we had absolute impeccable records. So you want to make sure, and the auditor would say, where's this receipt right here? And I'd go, well, it says that the number is 160605. It's going to be in June of 2016. Let's grab this book and let's see. It's right there. And oh, okay. All right. And so again, you just want to make sure that you've got a system to where you'll be able to organize it. By doing this as well, you're establishing a process to make sure that you're entering the receipts in there so that you're not losing them. So whatever your system is, come up with a system, train your staff on it, and follow it. Other questions?
Yes, I
This is Alma.
have, this is Alma. I have a question. I know you
Yep.
explained the difference between LLC and corporation.
Yes.
What is the difference between the LLC and corporation S? I know that there are some people that are more comfortable with the LLC than with corporations. So what is the difference between them?
So, you know, the legal structure, when you create a corporation, so LLCs are newer. When I say newer, I don't know, they've been around for 25 or 30 years, but they're newer in terms of, you know, the corporation's been around for maybe the 1800s. I feel like I should look up that answer. But what it did is, well, it did a few things. The corporation, when you invest your money in a corporation, you're able to buy a certain number of shares. And your loss, the potential loss, is limited to whatever you've invested into it. It creates an entity that is separate from the owner. And so in the event that the company is sued for any reason, they can sue the corporation, but they can't sue the owners of the corporation. Right now, if you have a 401k or an IRA or whatever you have, you probably own stock in Coca-Cola. If Coca-Cola gets sued, they can't come after you for more money. They can't go, oh, well, Coke doesn't have enough money. We want to go after all of the shareholders. And so Carolyn and Leticia and Sarah say that we want your money. They can't do that, right? So your potential when you buy $100 worth of stock in Coca-Cola, the most that you could possibly lose is $100. So that's the first thing that the corporation does. It creates an entity that is separate from the owner. And so it limits, in most cases, not in all, but in most cases, limits the potential for loss to that. And what that, you know, we would say that that is legal indemnification. It means that if the company is sued, typically they cannot, the name of this, the technical name is piercing the corporate veil. They cannot pierce the corporate veil. And what that means is that me, Bernie Deere, I am legally insulated from the company itself. There are two types of corporations that you can file as. One of them is called an S corporation, and the other one is called a C corporation. And there are some pretty significant differences in how those two corporations are taxed. An S corporation usually is for smaller corporations. You are limited to 100 shareholders. You cannot have more than 100 shareholders in an S corporation. The way that you are taxed is you will have to take some type of a salary from the organization, and you can shield the rest of that, as I said, as capital gains tax. The money that comes in, though, that capital gains will flow through as what's going to be, it's going to come through on your K1 statement. That's the tax form that you are going to get. And that's how the money is going to flow through onto your personal tax return. Once you've paid your taxes on that, whether you take the money out of the business or not doesn't matter. So you can say, well, look, I earned $100,000, but I didn't take anything out. Uncle Sam's going to go, yeah, I don't care. You earned $100,000. That's what you're going to pay tax on. A C corporation is not like that. A C corporation has no limit on the number of shareholders. So that is much more appropriate for any large company, any large corporation. So anything that is going to be on the stock exchange is always going to be a C corporation. The downside of C corporations, they are subject to what is called double taxation. So you may have heard this before. What happens is when the money is actually earned, the corporation will pay taxes on anything that is earned by the company. An S corp, the company doesn't pay any taxes. You, the owner, are the only person who pays taxes, or the only entity that pays taxes. With a C corporation, the corporation pays taxes, and then if you don't take anything out, you personally don't owe anything. You don't owe anything until you actually get your money. But here's where the double taxation comes in. When you do take your money out, now the corporation already paid their taxes, guess what? You're going to pay taxes a second time on that money. Okay, so that's a C corporation. In order to enjoy the protections that a corporation would give you. The federal government and the IRS does require that you do certain things. For instance, you are required every year to have an annual meeting of the board of directors and an annual meeting of the shareholders. You are required legally to take minutes of those meetings. If you're not familiar, minutes means that somebody is writing down what was talked about in those meetings. Even if you are the only shareholder, legally, you still have to have meeting minutes. And so you're going to say that on April 13th, the 2020 annual meeting of the shareholders, me, took place at this location, and you're going to say that, you know, that the budget was reviewed and approved as is, and here's the budget and all of these other things. You're required legally to have something that are called bylaws. Bylaws are the specifics that it determines what the organization is legally allowed to do. And all of this information is supposed to be kept somewhere on site in the organization. It is called your corporate records book, okay? At the end of the day, has any small business owner ever got in trouble for not having a corporate records book on site or for not having the bylaws? The answer is probably yes, but they've been very, very few and far between. Most companies form as an S Corp, and again, this is not legal advice. I am not telling you to do this. Many companies form as an S Corp and never do any of this, and life moves along fine for 20 years. On the flip side, more recently, a new company has come to light that is called a limited liability company. A company an LLC is not a corporation, but it offers all of the exact same protections as you would get with a corporation. Primarily, the LLC is an independent entity that is separate from the business owner, and it also offers you the exact same legal indemnification, which means that if the LLC is sued for any reason, typically they cannot get through to the owner. I keep on throwing that typically out here, and there's the reason why. That piercing the corporate veil can be done in the event that the government determines that you have acted so recklessly that you have abused the protection. So let's say that you were stealing from people and then you just took all of the money out of the company. You can't go, well, you can only go after the corporation. You can't come after me. The government's going to say, no, you've acted very carelessly and with wanton disregard and neglect for other people's personal safety or whatever it is, and that you've manipulated the system. They will, in very limited situations, pierce the corporate veil, which means that they will allow somebody to sue you directly, but often it's not allowed. Same thing with an LLC. With an LLC, if you do not file any additional paperwork and you simply file your LLC, which is very cheap in Illinois right now, they lowered the price from, I think it was $610, and I think it's probably $60 now. So that's a pretty darn good price to file the LLC. If you're an LLC, if you don't file, so let me start by saying this. If you're an LLC, you get to elect how do you want to be taxed. You can be taxed as an S Corp, as a C Corp, or as a sole proprietor / partnership. You can be taxed however you want. I believe that it's probably most favorable to small businesses generally to be taxed as an S Corp, but you can make your, talk about that with your tax professional. But so you can just file, so you can be an LLC. If you don't file anything, by default, you are going to be taxed as a sole proprietor if you are the only individual, or as a partnership if there are two of you. They're going to treat you the exact same way as if you were just a sole proprietor. Generally, that's not the most advantageous tax approach. So you might say, well, no, I'm going to file this 52 or 5395, whatever it is. And again, specifically, the name of that is an election by a limited liability company to be taxed as an S corporation, or there is a form that is a election by a limited liability company to be taxed as a C corporation. So I think to answer your question, Alma, both corporations and limited liability companies do offer legal indemnification. However, unlike the corporation, the legal requirements for the LLC are they're laxed significantly. You don't have to have an annual meeting. You don't have to have bylaws. You don't have to have the corporate, like you don't have to do any of that stuff. It removes all of that. One of the other unique things that you can do with a limited liability company, and I'll stop belaboring the point after this, but you have the ability to set up what is called a series LLC. And this is very, very helpful in the event that you have multiple businesses that you would like to run as a single business, but still insulate from each other. So let's say that you owned coffee shops, and I own 6 coffee shops. I don't want to have 6 different companies and file 6 different tax returns and all of these different things. I can run all of those as though they were a single company, but I can make them compartmentalized in terms of legal liability. So if somebody slips and hurts themselves at one of my coffee shops, that liability is limited to that single business unit, even though they are all the same company. And it can be the same if you owned apartment buildings. If you had 6 apartment buildings, most of the time you'll end up filing a series LLC. There is a single company, although for legal purposes, each one of those apartment buildings are treated as an independent legal entity, but there's still one tax return. I don't know if that whole mouthful makes sense, but Alma, does that answer your question?
Yes, very specific. Thank you. I guess Bernie, I guess because when this is Sulma now, because when we went ahead and we did a corporation,
Yep.
I'm not sure if we were specific on the type of corporation that we wanted. So when we did the taxes, IRS, the first year that we did our taxes, IRS came back and said that we were a C Corp instead of an S Corp. And we had to,
Confusing.
yeah, that was very confusing in the beginning. So we had to go ahead and
File.
file for the S corporation and have them accepted as an S corporation so we could do our taxes as such.
Yep.
So that was like the main big question. What or why did they do that?
So when you fill out your paperwork, you pick one or the other, and that does affect your tax status, like I said. So if as a C corporation, I mean, you could file as a C corporation. It doesn't hurt you. There's no reason why you cannot be a C corporation. You could leave it that way if you'd like, but you are going to pay double taxation, and so your accountant may have recommended you to do that to try to again lower your tax burden.
Yes. Yeah, that we have to do that for the first year. So now we're verifying that every year we have to file it as an S corp. Make sure that I have been accepted as an S corp.
Yeah, so we don't have to be double taxed.
Yeah, the IRS will send you a letter, Zulma, and so you will get a letter from the IRS that says that they have recognized you as an S corporation. And you can call them anytime that you want. If you believe it or not, they're actually fairly helpful. There is a number there. You can call that number and they will give you some good information and help you through it. I think that they're pretty understanding with smaller businesses.
Yes.
Okay. Thank you.
Yep. Yeah, but you should get a letter from the IRS. And I'm sorry, let me pause for a second. Are you telling me that you formed the company improperly, meaning that you intended to be an S corp? However, you actually created a C corp, or are you telling me that you just filed the wrong tax documents?
No, when we filed the taxes, we filed as an S corp. Me myself thinking that was what we had, but then the IRS said we don't find an S corp.
You told your accountant that you were an S corp,
Yes.
even though you filed as a C corp. Understood. Okay. Yep. So yeah, so if you have to file your tax. The forms are actually different. They're completely different forms that you will use.
Thanks.
Yeah. So and again, trying to avoid that double taxation because it's no need for that.
Yeah. I mean, there may be times, so somebody asked a question where for whatever reason they had to make under a certain amount of money, and then a C corporation might be the way to do it, right? Because you go, well, no, I didn't make the money. The company made that money. You are only going to get taxed when you start taking the money out of the company, right? Where with an S corp, they don't care. I don't care what you do with the money. You made the money. You're going to pay the taxes on it, right? So there are benefits to it at times. Like right now, what you don't want to do is Coca-Cola, makes a ton of money this year. You don't want the government sending you a bill and going, hey, Zoma, I see that you own Coke. You owe us money. You're an S Corp, right? You're like, no. They didn't give me any money, right? So if I didn't get any money in my pocket, I don't want to pay the taxes.
Okay, that's
Yes.
true.
That's right. Okay, thank you.
Yep, absolutely. Any other questions from anyone? No? Yes? All right. Well, everyone, I will look forward to talking with everybody on Wednesday. We will figure out one way or the other what we're doing. If it's Zoom or GoToMeeting or whatever we are doing, we'll get that all settled before then. But yeah, just log on just 5 minutes early. We do start at 5:30. Log on just a couple of minutes early, and just make sure that we don't have any issues.
Okay, thank you.
All right, thank you.
Yep.
See you on
Thanks,
Wednesday.
everyone. Yep. Have a good evening. Stay
Have
safe.
a good
We'll talk Wednesday. Thanks.
Take care.
Thank you, Bernie. I appreciate it. Have a good
Yep.
night.
Absolutely.
Thanks
And
much,
Mary,
Bernie.
Bye-bye.